Hey everybody, today we are going to talk about asset-based loans. We're going to cover what does that even mean? What is an asset-based loan? And we'll dive into things like how does my credit come into the equation, or does it at all? What kind of leverage can we get? How does the property factor in here? All of those type of things are what we're going to cover here. We're going to go off the cuff. It's going to be fun. We'll all learn something along the way. So if you find this video or any of our other videos helpful, please hit the subscribe button somewhere down here, and the like button and the notification button. That helps us out so we can keep producing good content for you guys. So with that being said, let's dive in. All right, asset-based loans. We've all heard of it. It might be helpful, it might not. We don't really know. It's tricky. So you hear this word and this phrase floating around, asset-based loan or asset-based lending. It exists, certainly, but with a lot of the conversations that I have with investors, there generally seems to be a misunderstanding of what that phrase actually means in effect. So let's talk about, first of all, the high level. What is an asset-based loan? And number one, it means that the underwriting for the transaction or the loan is primarily based on the income potential of the asset itself, so the real estate, right? So we've got a commercial property and it has the ability to produce a monthly income of X dollars against a debt service of X dollars, right? And there needs to be a little spread there, right? That would make sense. That's why you want to buy the property. Or a property that you want to purchase, rehab, and sell. There's an income potential there, right? I purchase it for cheap, I rehab it for X, and my sale is X times 2 or 3, right? And you get that spread. So there's your income potential, right? So that is the primary focus of an asset-based loan in that scenario, right? Now here is where I guess what I'll do is contrast that to a non-asset-based loan, because you can get a non-asset-based loan for those same two transactions, right? But the difference is the non-asset-based loan, or like a conventional bank loan, is subtle but significant. It's the difference between underwriting only the property's ability to generate that income spread versus underwriting that in addition to your personal income potential or your actual income, right? Or your global or personal debt to income. And on your conventional loan or bank loan, that is an equally significant factor as your personal debt to income as the asset itself. And for real estate investors, that very quickly becomes a problem. Many of our clients, and you'll know for yourself, the more properties you get, you've got money in those, and hey, maybe I don't need to work my W-2 job. You stop doing that, qualifying for that personal debt to income non-asset-based loan becomes basically impossible, right? So then you switch over to asset-based lending. So that's kind of the context of the conversation, and the kind of big picture of what an asset-based loan. Now, let me kind of dive into what it is not and give you an explanation of why maybe yours or what you've seen floating around there, and I see this all the time, the preconceived notion that an asset-based loan has nothing at all to do with the borrower, because that simply is not true. So I'm going to tell you why as well. But I get calls all the time from my clients and they ask for this because they've got credit issues, right, that they don't want underwritten. And so they say, well, I need a truly asset-based loan, right, where they don't look at credit and they have no issues, like if you've got background issues, right, criminal, financial, any of that stuff. They say, well, I need an asset-based loan where none of that is considered whatsoever. And we say, well, hey man, that doesn't really exist, because at the end of the day, here's the crux of the situation is, yes, it's an asset-based loan, but at the end of the day, who's that money going to, right? Do we say here, right, here's this thing, I'm gonna make a loan to this calculator right here, here's an asset, right? If I throw money at this calculator, and I'm the lender, am I gonna get paid back by this here calculator? No, of course not. I'm going to get paid back by whoever owns this asset. That's the human being behind the transaction that needs to be reliable to pay, right? Now, we're going to make sure that the asset is going to put them in a good position to be able to pay, right? We don't want to put them in a bad position, right? But at the end of the day, an asset-based loan is just saying, yeah, this asset right here, this actual structure, non-human being structure, the asset has a good potential to allow the borrower to pay back the loan. But at the end of the day, who pays? The answer is a human being, right? So your credit, your payment history, your background absolutely matters, even though that loan that you're getting is an asset-based loan in the sense that it is not underwriting your personal ability to generate income. It's underwriting the asset's ability to generate income for you, the borrower, who has a track record yourself of ability to pay or not. And hey, I get it. There are circumstances in life that come up, medical, divorces, like things that are unfortunate, but can dramatically affect your credit. And at the end of the day, that is usually the strongest indicator that asset-based lenders are using to look at the borrower's ability to pay. It is what it is. I understand that it's confusing, it's frustrating, especially when we've got extenuating circumstances like that, but it's the fact of the matter, and that's kind of the lending world, because at the end of the day, we have an asset and we also have a human being that is going to be paying on that loan, right? So that's kind of the, here's what it is, here's what it's, you might think that it is, but it's not, right? Let me kind of dive into each of those factors and kind of give you a little bit of like a look under the hood to understand how those affect, because on a more asset-based loan, your credit, even though it may be not the most pristine factor, it can certainly become easier to work with, right? So let's gonna just dive in off the cuff about some of the risk factors on these asset-based loans and how we can mitigate that. So big risk here, now I need to mitigate it with something on the other side. So if I've got a deal that is, let's call it a fix and flip deal, I'm buying it a provable high quality value, right? I get an appraisal that shows that I'm buying at a discount and I'm going to do X dollars in rehab, and a third party appraisal confirms that yes, we bought it well with the rehab dollars that we said we're going to do. It's going to increase the value and we have a really nice spread, right? This asset looks really strong. So hey, if we've got some issues over here on the borrower side, do you think we might have some mitigating factors? Absolutely, right? So if you've got those sticky things on your credit score, finding a higher quality deal will cover some things over here that may be less helpful in the underwriting process, right? So finding a high quality deal, not only just generally you want to do that, but it's almost a prerequisite for challenged borrowers, we'll call that, right? So we've got that. High quality deal will help in a lot of situations. Won't solve every problem though, right? Now let's talk about FICO, right? On a short-term bridge loan, there's quite a bit more, the berth is wider, so to speak, on what credit tiers are allowed, because at the end of the day, the loan program is designed to deal with you for, let's call it 12 months. Generally, the longest term bridge loan is going to be 36 months, but some are short term, right? Not 30 years, right? So there's going to be a little bit more forgiveness for things like that and an ability to work with you. So on our platform, we've got programs that can easily work down, 650 is like hey, we got you covered. 600 and below certainly is there as well, right? So that is a factor and it should be protected, but shorter term, easier to work with. Longer term, a little bit harder to work with, even though it's still asset based. Just like we talked before, it's a human being that's still paying, and that is, whether it's fair or not, credit is kind of that borrower factor that's being underwritten. Okay, the last thing before we talk about the actual loan itself that becomes a mitigating factor is is liquidity. So if you've got a big padding in your pocketbook as far as cash equivalents, true liquidity, that will, cover a lot of sins, so to speak, on a deal or on your borrower profile, so to speak. So liquidity is very, very, very helpful. So if you've got a big spread there, a lender's going to say, all right, if something goes a little bit sideways here, at least this guy's, got the ability to cover it a little bit out of pocket. Because at the end of the day, nobody wants the foreclosure to happen. Lender doesn't want to do that. It's expensive. Borrower doesn't want that to happen because, hey, that kind of sticks on your profile for a long time and it's just a hassle. So nobody wants it to happen. A nice padding of liquidity is a really big comfort factor for the underwriting process, even on an asset-based loan. Now let's kind of talk leverages, right? So if we've got a challenged borrower who just so happens to be my right hand for whatever reason, and a higher quality deal, right? A mitigating factor in here is that if it's challenged to qualify here, sometimes a lower leverage is a way that you can still get into the transaction, right? Requires a little bit more skin in the game, so to speak. So it makes it from a risk perspective harder to walk away from because you do have more skin or cash in the game. But that is one mitigating factor that on an asset-based loan you can account for if you are in that challenged borrower kind of profile, is put a couple more bucks in and you can get some more things done. So that's a handful of the things that kind of go into this asset-based lending world. But overall, what I'm trying to get across here is, to my knowledge and in all reality, you can, I think, easily understand how a truly asset-based loan can't really exist, because pretend this is my asset again, right? If I throw money at it, neat. I have money stuck to a calculator. For your rental property, I could nail it to the wall. How am I getting it back? The only way you get it back is an actual human being. So there is not going to be a loan where a loan is made to a building itself. There's always a human being behind it. We're not talking about recourse or non-recourse. That's a whole different conversation. But what I am trying to heavily emphasize is that even on a heavily asset-based loan, the human being behind the transaction always matters. So if you're looking to partner, choose a good partner. If you've got challenged things on your credit or background, do what you can to legally have those removed or improve your credit, make your payments, call us. We may have a recommendation, or we can point you in the right direction of somebody that can help you out, because it absolutely does matter. I work in this world. I work with clients of all tiers, right? Apparently, again, my clients, the borrowers over here, we've got the premium clients, right? And then I've got the more challenged clients. My job with my clients is to get the best available wherever you're at, right? So it is what it is. So do your best, and whoever you're working with for your loans and finding your deals, they should be doing their best, but all they can deal with is what you bring to the table. So you got to have a good deal, right? And you already know that. You're finding those good deals. You're a high quality investor, but you can help yourself out by improving your credit, improving your background, right? Making sure that things that maybe were put on there in error actually get resolved. I can tell you a lot of that stuff will gum up a deal, and it is what it is. So make sure you're monitoring those things, because the truly asset-based loan that you think is going to save your pants, where they're not going to look at you at all, I have to tell you, it's not going to be there for you. Your background and credit is going to be a factor, sometimes more or less, but it is a factor. So that opens up a whole can of worms that we'll address in other videos, and we'll provide more education. But asset-based lending, that's what I wanted to cover today. We totally went off the cuff. I hope that was helpful. Again, if you did think it was helpful, please subscribe. I think it's right here. Hit the like button and hit the notification bell, please. It'll kind of give us some feedback that this is being helpful to you. So, hey, we'll make another video for you next time, and good luck investing. And if you need help with anything, check out LoanBidz with a Z.com. Love to help you out. Talk to you soon. Bye.